my background is in income tax, and so my answers may be a little biased toward my own field, because I would definitely say that the biggest mistake that musicians make is not getting educated soon enough about what their sort of tax obligations are. I see a lot of people sort of let that slide, and I understand the urge, right? I understand that you don't devote your education and your energy and your life to music so that you can spend a lot of time doing your taxes, right? That's not generally what you got into it for. And so I understand the urge to let it go. But the thing is, it's like a lot of things that matter in the long term, like your health. It's one of those things that's really easy in the moment to put off for another day. And the consequences tend to be dire as those days and months and years pile up. So to me, you need to know what your obligations are. You need to know what your filing responsibilities are. And you need to be keeping up with that kind of from the start. And it's kind of it's not very glamorous to keep good records and file your taxes on time and set money aside for tax. Um, but that's the way kind of infrastructure works, right? If you do it well, there's no drama, and if you do it poorly, there's a lot of drama. And I think that musicians who want to keep out of financial drama do well to pay attention to this stuff early on and just stay on top of it. That you'd be avoiding your major mistake just by doing that. So, short-term planning, I'm going to talk about what you need to um, what you need to be doing in the short term to make sure that everything's going to work out in the long term. Because the short term is, a guitar string broke, I need a new one. Like, I don't need to tell you what you need in the short term financially. But what you do need to be thinking about is what you need to do and remember in the short term to make sure that the things that you're not thinking about right now are also taken care of. So, one basic thing is keeping your financial records in good order and somewhere safe. So, in good order, what I mean by that is, you know, you're going to be needing, in order to minimize your taxes, you're going to need to write off some expenses. In order to be able to defend those expenses, if you're ever asked about them by the Canada Revenue Agency, you need to have good records. You need to keep those receipts. And there are some receipts that make sense to you now, but you could get asked a question about them 3 or even 7 years from now, and you need to still know what they're about. So any receipts that aren't 100% clear to you, or that might not be clear to somebody who has amnesia, which is kind of who you become 3 to 7 years from now, make notes on them, right? So obviously a receipt that's from Long and McQuaid that literally says it's for an amplifier doesn't really require a note. You know exactly what it is, no problem. But if you keep a receipt because you had a business meeting at a restaurant, are you going to remember who you met with? Are you going to remember what that business meeting was about? Because if you ever get reviewed by the Canada Revenue Agency, they are actually going to ask those questions. So before you put the receipt in the shoebox, probably never to be seen again, write that down. Write down the details of why this was a business expense if it's not 100% clear from the receipt, because trust me, you will not remember. So that's one short-term thing. Another short-term thing is setting aside money for your income taxes as you earn it. So generally, you don't get your tax bill until you file your tax return. Right now, we're talking it's the spring of the year. So people are filing your tax returns that cover the calendar year that ended 4 or 5 months ago. So if it turns out that they owe income tax, and people who work freelance, which includes most musicians, do tend to owe income tax because when they earn the money, nobody's withholding any tax on that. So you definitely want to withhold some tax yourself as you're earning it and not trying to scrape it up together the following spring. And we usually advise people to start, if they're not really sure, set aside 15 to 20% of every dollar you earn freelance. And that should cover you. If you're even the slightest bit concerned that that might not be enough, go up to 25. Typically, you won't have to go any higher than 25% of your income tax to cover your income tax bill. but we do advise that you do at least 15 to 20% as you're earning it. So that's the short term. In the long term, you want to have the kind of practices that are going to keep you out of debt and heading toward savings. Now, that is actually the same process. Staying out of debt and making savings are basically two sides of the very same coin. And that coin is living within your means or slightly below your means. If you want to have a, a future life of lack of worry and lack of pain and lack of the kind of drama that nobody wants, you learn to live below your means, even by a tiny, tiny amount. That really is living within your means is the difference between being in debt and never being in debt. And that will be a great thing. And living below your means is the difference between getting by and getting increasingly comfortable as your life goes on. So living below your means, when you're first starting out and your means are really tiny, it's very, very hard to do. Almost maybe impossible, but I would never really say impossible. Frankly, if it's impossible to live within your means, you need to get another job. That's a fact. If it's just hard, do it. Trust me, because the consequences of not doing it are harder. There's not a huge amount of difference. I mean, no matter what the issues are, I mean, I assume that the band is working freelance as well. You're not a salaried member of a band and you're not a salaried session musician. That's what session kind of means. So it's really the same. Every dollar that you earn, you are putting aside 15 to 25% of it for your taxes. You are keeping an eye on your total gross income to make sure that it's not yet time to register for the GST or HST. That's when you hit the $30,000 a year mark freelance that you're going to want to start thinking about that. But other than that, it's kind of the same. One thing is if you're the band leader, you know, you work a club and the check goes to you, you don't have to set aside 25% of that check. You have to set aside 25% of your part of that check because obviously you're going to have to pay your fellow musicians out of that. So if you're in a 5-piece, you're going to look at 20% of that check and set aside 20% of that, not the whole check. You are going to report that whole amount on your income taxes as part of your income, and then you're going to write off the parts that you paid out to your session musicians or to your band. You're not actually going to have to. You're not actually going to have to pay tax on that because that will be subtracted out when you take off your expenses. So that's about it. So I want to start with when we talk about the HST and we talk about the GST, these are essentially two forms of the same tax and they function under the same system. Just in case, you know, somebody watching this is actually in a province where they don't use HST. There are some provinces that use the GST system. It's the differences don't really matter for the purpose of this discussion. So a GST HST number, and forgive me if I say one or the other sometimes, essentially, if I say GST, I also mean HST and vice versa. So this is a sales tax that certain people called registrants need to charge on top of their fees and then send off to the government. So when I say only certain people have to do it, if you're self-employed and the income that you're generating is small enough, you are small enough to sort of opt out of this system. And by opting out, it just means you don't do anything. You don't become a registrant, you don't collect it, you don't send it in, you don't do anything. So when you are earning less than $30,000 in a 12-month period, you can just opt out until you cross over and you're making more than 30,000. And at that point, you are obliged by law to become a registrant. You contact the Canada Revenue Agency, you tell them that you've crossed that, what they call the small supplier threshold, that's what the $30,000 line is, and that you want to register for the GST, HST. They'll give you a number, and from that point forward, you must charge it on top of your fees, even if you have a low earning year. So even if your earnings drop back to $10,000 freelance, once you've registered, you have to keep collecting it on your freelance fees, only freelance, but you must keep collecting it until or unless you suspend or close that GST HST account. So this just goes on until you close it. So you are adding a tax on top of your fees. That tax does not belong to you. Set it aside along with the income tax that you're setting aside. I also want you to set aside the taxes, the HST or GST that you're collecting, also going to get set aside. When all is said and done, when you actually file your GST HST return, because being a registrant means collecting it, filing return to report what you did, and remitting it, these three steps. When you file your return, though, you get to actually calculate the HST or GST that you spent on your business. So any purchases, obviously any purchases in Canada are going to include a GST or an HST tax. You're going to actually get that tax back in the long run. That's part of the system as well. So if you set aside all the GST or HST you collect once you become a registrant, you actually are going to send in some of that minus a little bit. And that is the little bit that you're going to claim back from what you spent on your business. And you just get to keep that. So if you set aside everything you collect, there's no situation in which you will not have enough to remit to the government. You'll be perfectly fine. And it just is one more piece of paper that you do have to file regularly with the government. It is actually so integrated into your income situation that here, at my firm, Personal Tax Advisors, we actually do that calculation as part of your taxes anyway, and we file that return for free. The GST return, we just file it for free. So it's not a huge burden, but it is something else that you have to be aware of. And it is up to you to know when you cross that $30,000 threshold. It is up to you to call the Canada Revenue Agency and register. If you don't do it, nothing will happen, not right away. Instead, sometime down the line, CRA will notice your income, come back to you, retroactively register you, and ask you for all the tax that you were supposed to be collecting and weren't. And you're going to have to find that money. So another situation, stay on top of it, not a big deal. You register when it's time, you do what you have to do. Don't stay on top of it, miss that point, and it becomes a nightmare of scraping up money that you don't have and giving it to the government. In tax world, we don't have a lot of happy surprises. The unpleasant surprise, well, one of them, of course, is the one I just mentioned about discovering that you have been retroactively registered for the HST, GST. That is a surprise. But the main surprise, another unpleasant surprise, is that even after a year of making kind of modest money or low money even, you may still owe income tax. Self-employed people do tend to owe simply because as they are earning their income, no tax is being set aside on their behalf. So it's just a reality that in general, self-employed people are less likely to get a refund. They're more likely to owe. But what does surprise people in a negative way is that they can have a year where they're making an amount of money that feels like a punishment and still owe income tax. And so that is why I put this strong emphasis on setting it aside, even if it's hard to set aside that money. Because if you're earning very, very modest money and you are trying to listen to me and live within your means, and I'm telling you to also set aside, 15 to 20% of your income for tax and then live within what's left, and that is very, very hard. I don't deny that. But it is also a truth that no matter how hard that is, I promise you that trying to find the money at the end of a year where you did not set it aside is always harder. Always, always, always harder. It doesn't actually, unless you've got some sort of magic ball where you know that there's going to be like a windfall at the end of the year, things are not going to change. They're going to be what they are. And so if you can't set aside the 15 to 20% now, trust me, you're not going to be able to find that 15 or 20% later. So do that to make sure that you're covered so that you can avoid no surprise is what you want. The goal is no surprise. So if you're living within your means or below your means, if you're keeping your good records, if you're setting aside money for tax, if you're registering for the GST, HST when you're supposed to, and setting that aside, that is how you're going to avoid the worst possible thing, which is a surprise. That's what we're aiming for.